Bypass the middleman, banks, and credit unions for your emergency funds. In this educational video episode, I'm going to address the question, what do savvy investors keep their money in for emergencies? It's probably not what you think. So I'm Doug Andrew, and I've been helping thousands of people optimize their assets and minimize taxes now for nearly 5 decades. I've been very honored in my career to have authored thus far 12 books. I'm working on my 13th. And at the end of this episode, I want to gift you a copy of my 11th book. It's called The Laser Fund. It's been flying off of our warehouse shelves, and I'll pay for the book and I'll fire out a copy to you. You're going to want one because it's called The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. It's a 300-page book and it retails for $20 on Amazon. I'm going to gift one to you absolutely free, so stay with me. But in the book, I talk about how you can use the Laser Fund for all kinds of financial goals, like the dream solution for retirement planning, for college funding, for your real estate management, for your business working capital, your estate planning, but emergency funds. So I'm going to tell you a story or two of people that I met with that had hundreds of thousands of dollars just sitting in banks or credit unions earning less than 1% to have on hand in the event of an emergency. And it never ceased to amaze me. I would go, what kind of an emergency are you planning for? Okay. So when people think of an emergency fund, usually they want to have money on hand, liquid. And sometimes they think liquidity means a drive-up window. So they think the bank or the credit union. They want it to be safe, and so they think bank or credit union because it's FDIC insured or whatever. But they don't think about rate of return, okay? And the rate of return at a bank or credit union is pathetic. Usually way less than the inflation rate at any given time. And so as of the recording of this episode, interest rates are starting to creep back up again. But for nearly 2 decades, we've had 40-year low interest rates where you're rowing upstream, so to speak, at the rate of 1 mile an hour, 1% interest in a bank or credit union. And the current of inflation is coming down at 3, 4, 5, 8, 10. You're going backwards. And sometimes people say, well, that's just what I have to put up with for my emergency funds. Well, how much should you have in an emergency fund? Depending upon what books you read or who you're talking to, generally speaking, a lot of financial advisors will say, well, 6 months of your income or 6 months of your bare bones minimum expenses, maybe up to 12 months, okay? So let's say that is $5,000 a month. So that'd be $60,000 if it's 6 months, or maybe $120,000 if you wanted a year's cushion if you lost your job and you needed at least $5,000 a month to keep the wolves away from the door or whatever. Okay, let's just use that as an example. Well, a lot of people think, okay, so I need 60 or 100 or 120,000 in a bank or credit union. No, you don't, okay? Truth be known, your bank or credit union does not keep that money in a vault, okay? They're paying you interest even though it's nominal. Are they just a benevolent institution? No. What are they doing with your money? Well, a certain percent of it, they're loaning out to people to buy homes or business owners or whatever, but they have to have money on hand, liquid and safe, in the event you walk in the door and say, I want 50,000 or 100,000. Now they know there's only a small percentage of people at any given moment that's going to do that, but they do have to have money that they can access in case of a run or a panic on the bank, okay? Guess where they put that money? In 2008, there were over 400 banks that went under. 900 more were on the watch list, on the brink of going under. A lot of Americans don't realize how close we came to a total financial collapse in America. The federal government asked the 5 major banks in America in 2008 to disclose where they had their Tier 1 assets. What's a Tier 1 asset? That's money that they have earmarked. It has to be on hand, liquid, and safe. They can grab it within 24 to 48 hours if push comes to shove, at least within a week, in the event of a run on their bank. Okay, that's called a Tier 1 asset. Guess where the 5 major banks disclosed they had 30 to 40% of their Tier 1 assets? In insurance companies, often in the form of BOLI, B-O-L-I, bank-owned life insurance. And people go, what? Why would banks own life insurance? Because they own the insurance policy on people. What people? It could be their stockholders, their board of directors, whoever, it doesn't matter. It's the owner of the insurance policy that gets all the cash value, access, all the growth. So they know that the multi-trillion-dollar insurance industry is not only the backbone of America, but the backbone of the world. They've come through the Great Depression with flying colors when banks closed and 40% never reopened again. Same thing happened in 2008. Not one single legal reserve insurance company went under, but 400 banks did and 900 more were on the brink of going under. So the banks take your money and put it into insurance companies. Now, they do it for liquidity and safety. They can access that money with an electronic funds transfer or phone call if push comes to shove. But what else are they doing? They're increasing the liquidity and the safety and the rate of return by 500%. So what's happening? The bank is borrowing your money. See, there's 4 things you can do with money: spend it, lend it, own with it, or give it away. When you have your money in a bank or a credit union or an insurance company, it's in a lended position. Are they just benevolent, paying you interest? No. They're putting that money to work. In this case, the banks and credit unions are taking some of that OPM, other people's money. They're putting it into insurance companies. Now, these insurance companies where I put my money, and banks are very picky which insurance companies they put their money into, are usually rated AAA. That would be an S&P rating. Do you know that a lot of these banks who are putting money into AAA insurance companies, the bank is only rated BBB? And people say, oh, well, that's just one notch higher. No, it isn't. The difference between BBB and AAA is like 6 notches higher in safety. So your bank or credit union is taking your money and increasing the safety by 6 notches higher in safety, and they're paying you 1%. So every million they borrow and pay you $10,000 a year in interest, they're turning around and earning 5% at in the insurance company or more. How much more is 5 than 1? Don't say 4, okay? It's 500%. They're making 50 grand. How much more is 50,000 than 10,000? It's 5 times or 500%. Sometimes I ask, would you hire an employee for 10 grand that made you an extra 50 grand? Would you buy a widget machine for 10 grand that made you an extra 50 grand? That's called a 500% return on employment costs or equipment costs. Business owners get this. So the bank and credit union is paying you 1 and they're earning 5 times that, or 5. They're increasing the rate of return by 5 times and the safety by 5 to 6 notches. I'm just saying, why don't you bypass the middleman? Why don't you put your emergency funds where the bank is putting your emergency fund, okay? And you might want to keep 1 month on hand. You might want to keep 5,000 in a bank, no more than 10,000, depending on, what you define as an emergency. But the rest of that, 60 to 120,000 in this example, I would put it in an insurance company in a max-funded indexed universal life insurance contract, which is like the dream solution for an emergency fund. I can call up the insurance company just like a bank can, and I can access my money if push comes to shove with an electronic funds transfer or phone call. Most emergencies you don't need the money in 24 hours, but you can get it in 3 or 4 days. Just because it doesn't have a drive-up window in this day and age, you can access the money just with one form and you email it, you fax it in, and they will process that normally in 7 to 10 days. But if you say, this is an emergency, I've got it done for clients in 24 hours. So why in the world would you ever give up rate of return and safety to put your emergency funds in a bank or credit union, except for a very small amount, maybe 1 or 2 months worth? Everything over and above that, up to the 6 or 12 months emergency funds that you ought to have, my heavens, bypass the middleman and put it where they put your money. Does that make sense? You'll be missing out on a fortune if you don't do what I'm talking about. I'll tell you a quick little story. One time I was meeting with a sweet widow, and she had, golly, it was several $100,000 in her credit union. And I said, so what's this earmarked for? And she said, well, it's my little, cushy emergency fund. I go, emergency? What kind of emergencies do you anticipate? She says, well, I was thinking about taking a little trip. And, it was about $500,000. And I said, where? To the moon? What in the world are you thinking? Do you know what you're giving up as far as safety and rate of return by having that much money in your bank? Well, it's FDIC insured. Well, did you notice the word insured? Guess what? The government, they can tax us and they can print money to make sure you're taken care of, because they have actually run out of money when they were bailing out the savings and loans. But why don't you put your emergency funds where your bank or your credit union is putting 30 to 40% of their emergency funds for liquidity and safety? Does that make sense? So this is why I strongly recommend to do what savvy investors do. Earn a higher rate of return, have greater safety, and you can have as much or more liquidity if push comes to shove. Do you know a bank or credit union, if they really got into trouble, can say, sorry, you cannot have money out of your savings account for 6 months? Yeah, they have to protect themselves by federal law in case there is a horrible run on the bank. Now, that has not happened since the Great Depression that I'm aware of, but they can actually stall you 6 months. Why do you want to risk that? Just put it into the institutions that the banks and credit unions are using for your emergency funds. If you want to learn more about all of the various uses of this laser fund, which is a max-funded IUL, read this book. I mentioned I want to gift you a copy. I'll pay for the book. It retails for $20 on Amazon. I want to gift you a copy. So you simply go to laserfund, laserfund.com, or click on the link below, and you contribute a nominal amount towards the shipping and handling. You have a little bit of skin in the game, and I'll cover the rest of that cost. I'll pay for the book, and I'll fire out a hard copy to you. It's 2 books in one. This side is all the charts and graphs and explanations. This side are all the stories of how many clients have used this for all kinds of goals, including one chapter on emergency funds. Now, folks, if you want to use both your right brain and left brain, read both of these. But claim your free copy. Go to laserfund.com. This is about your brighter future. Check out how you can listen and learn, watch and learn. We hold educational webinars all the time. You can register for one of those. You can even schedule an appointment with an IUL specialist that I oversee, where you can learn and see how this could be applied in your particular set of circumstances with no cost or obligation. And these are the ones that I oversee, because if you do it incorrectly by going to the wrong advisor, you will regret it. You want to make sure it's set up correctly and funded properly. Then it will qualify to be what I call a laser fund.